Ladies and gentlemen, good day and welcome to the JK Tyre Industries Limited Q4 FY22-23 results conference call hosted by ICICI Securities. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Basudev Banerjee, Vice President at ICICI Securities Limited. Thank you, and over to you, sir.
Hi, thanks. Morning to all participants, and thanks to the management for giving us the opportunity to host the call. I'd like to introduce the management represented by Mr. Anshuman Singhania, Managing Director, Mr. Arun Bajoria, Director and President International Business, Mr. Anuj Kathuria, President India Business, Mr. Sanjeev Agarwal, CFO, and Mr. E.K. Kinda, Financial Advisor. So without wasting any time, I'd like to hand over the call to Mr. Anshuman Singhania for his initial comments. Over to you, sir.
Yeah, thank you. A very good morning to everyone. It is with great pleasure that I welcome you all for the Q4 FY23 earning calls. I am Anshuman Singhania, Managing Director. I have with me Mr. Arun K. Bajoria, Director, President International, Mr. Anuj Kathuria, President India, Mr. A.K. Kindra, Financial Advisor, and Mr. Sanjeev Agarwal, CFO of the company. At the outset, let me thank all our customers, channel partners, bankers, and stakeholders for continued partnering and trust reimposed in JK's growth journey. We are delighted to share the performance highlights of Q4 FY23 and FY23, which ended on a very positive note. In terms of record high revenues of rupees 14,681 crores, registering an increase of 22% on year-on-year basis. Operating margins recovered to double-digit level in Q4 FY23. Subsidiary companies, namely Cavendish Industries Limited and Tornel Mexico, continued to perform well and contributed significantly to the revenues and profitability on the consolidated basis. Talking about the performance, Q4 was another strong quarter as far as the domestic business is concerned, which witnessed a healthy growth in the key product segments like commercial passenger vehicles, tires, led by strong replacement and OE demand. However, the growth in the domestic business was offset by export sluggishness witnessed during the quarter owing to economic and geopolitical conditions globally. Export sales were subdued at rupees 331 crores in Q4 FY23, resulting in lower exports of the year FY23 at rupees 1787 crores. We expect normalization of export in H2 FY24 onwards. Operating margins improved sequentially in the Q4 of FY23, aided by softening of input costs and commodity prices. We expect the margins to improve further in the coming quarters on account of stable raw material prices scenario. Automobile industry continues to witness buoyant demand in the CV and PV segments, leading to further strengthening in FY24 on the back of continued thrust of government on infrastructure development and easing in the chip shortage and rising disposable income. On the overall outlook, we remain optimistic on the tire industry growth path in the coming years on the back of uptick in the economic activities and sustained momentum in development of urban infrastructure and road construction projects. As we are progressing on our growth journey, we are focusing on better product mix, enhanced market presence, including geographical diversity, continued thrust on operational excellence and digitalization. This will lead to improved operational and financial performance. Product development. Our product strategy is to further align with the trends witnessed in terms of higher performance SKUs in the CV segment and bigger rim size tires to cater to the growing SUV segment. We have been frequently introducing new SKUs in these major product categories, including the EV vehicles, which are also now on the cusp of demand growth. We have recently launched the ultra high performance tires, Levitas Ultra range to strengthen our product portfolio and focus on premiumization in the marketplace for high-end luxury cars. Channel development. We are aggressively expanding our market reach through additional brand shops, onboarding new fleet customers, and have also been conducting customer interaction programs. Jaisa Vyapar, Vaisa Tire for better connect and spreading awareness of our products. In digitalization, we have undertaken projects for digital transformation across functions, including tech-enabled manufacturing at our plants, and we have started to accrue benefits. Such digitally supported efficiency and productivity initiatives will continue to be our utmost priority. Sustainability. Implementing sustainable practices, developing sustainable products, and setting global benchmarks in resource conservation is the key to our core values. In this direction, we have developed an all-new sustainable tire, US Green, in the passenger segment. The green tire delivers high performance with low carbon footprint compared to standard radial tires. The tire has been designed and developed using 80% sustainable materials. This development is not only a reflection of our highly competent R&D team, but also reinforces our serious commitment to advancing sustainable growth and boosting societal value creation. Moving towards carbon neutrality by 2050. New and mission. We have adopted the new vision of becoming a green and trusted mobility partner with missions set in line with our commitments towards focus on sustainable development, reducing carbon emission intensity, continuous process and product innovation, and customer centricity, which we believe will add significant value to all our stakeholders. As you are already aware, IFC, a member of the World Bank Group, has invested rupees 240 crores, USD 30 million in the company by way of CCDs on preferential basis, which reflects its confidence in the future of the company and the tire industry at large. Now I would request Mr. Bajoria ji to take us through the performance of Tornel, Mexico.
Thank you very much, MD sir. Regarding Tornel, JK Tornel continued to perform well in terms of overall revenue and profitability in financial year 23. JK Tornel achieved a turnover of rupees 2,673 crores as compared to rupees 2,120 crores in financial year 22, registering a growth of 26%. Operating profit, EBITDA, stood at rupees 215 crores vis-a-vis 187 crores in the financial year 22, despite headwinds in US and Latin American markets. Quarter 4 witnessed a revenue growth of 14% on year-on-year basis and 10% on quarter-on-quarter basis. Revenues for quarter 4 financial year 23 stood at rupees 671 crores. US and LATAM markets continue to face challenges of high inventory levels and destocking at distributors end due to reduced ocean freight rates from Asian countries, which resulted in pressures in terms of selling prices, thereby impacting operating margins in Q4 financial year 23. Going forward, the global demand is expected to improve. JK Tornel continues to enjoy healthy demand for PCR and LTR in the Mexican replacement and export markets. Going forward, our focus would be to improve volumes in these categories for overall improvement in business operations. JK Tornel organized 8th Dealer Conference and Customer Interaction Program CIP. Several new products were launched and showcased, which were very well received by the dealers and the distributors. JK Tornel has secured a 4-star rating in British Safety Council audit. Now I would request Mr. Sanjeev Agarwal, the CFO, to brief about the financial performance of this quarter.
Thank you, sir, and good morning to you all. Let me briefly highlight the financial performance for Q4 FY23 and financial year 23. For Q4, consolidated sales were recorded at rupees 3,645 crore vis-a-vis 3,320 crore in Q4 of last year, registering an increase of 10% on year-on-year basis. Profitability at EBITDA level in quarter 4 of FY23 was recorded at rupees 389 crore as against rupees 236 crore in Q4 FY22, an increase of 65% on year-on-year basis. Operating profit margins were recorded at 10.7%, an increase by about 110 basis points over the previous quarter. Cash profit for the quarter was recorded at 263 crore and profit after tax was rupees 112 crore, a threefold increase on YOY basis. On full year FY23, consolidated sales were up by 22%, which stood at 14,681 crore, contributed almost equally by volume growth and price increase. Operating profitability, EBITDA stood at rupees 1,334 crore, registering an increase of 20% over last year. Overall margins were flat as compared to the corresponding year in FY22. However, there has been a steady recovery since third quarter beginning, and in fourth quarter margins recovered by 360 basis points on YOY basis, taking it to a level of 10.7%. Though the interest cost has gone up by 9% over the last financial year, however, efforts are being made to contain the impact of high interest rate scenario. Profit after tax stood at rupees 264 crore, up by 31% over the corresponding period. All plants were running at higher capacity utilization level of about 90%. Export sales from India stood at rupees 1,787 crore and earnings per share improved to 10.64 per share as against 8.53 per share last year. The board has recommended a dividend of 100%, which is rupees 2 per share, having a face value of rupees 2 per share. Net debt stood at rupees 4,518 crore as on 31st of March 23, a reduction of rupees 422 crore over the previous year, led by improved working capital levels and scheduled debt repayment. Leverage ratios have improved significantly. Net debt to equity improved to 1.3x multiple in FY23 as against 1.7 times in FY22, and net debt to EBITDA improved to 3.4 in FY23 as against 4.5 in FY22. The balance sheet of the company is healthy with improved financial ratios, and we remain committed to deleverage our balance sheet through reduction in long-term borrowing and working capital management going forward as well. The already announced capacity expansion projects in PCR and TBR are under implementation stage and are progressing well. We have already circulated our earnings presentation, which is available on our website as well as on the website of stock exchanges. Now we open the forum for question and answer. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touch-tone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Jinesh Gandhi from Motilal Oswal Financial Services. Please go ahead.
Hi, sir. A couple of questions from my side. One is, can you talk about the volume growth which we saw in fourth quarter FY23, both in India and Mexico?
Well, the volume growth for the quarter from the corresponding quarter, we saw in the domestic market, we saw 14% growth, all the categories put together.
14% in India, that's what you're indicating. Okay. And for Mexico?
So 14% growth in Mexico in terms of value.
Value, okay. Okay. And when you're saying 14% growth in domestic on the volume side, it does mean that exports would have declined quite substantially, given that our revenue growth in India operations have been about 9%. So would that be fair assessment?
Yes, quarter 4, the exports were down.
Okay, and down and quite substantially down because overall revenue growth was just 9% and price increases on YY basis would have been good double digits. So
That's correct, Jinesh. I think your understanding is correct.
okay. Secondly, in this quarter we again saw quite healthy gross margin expansion. So do we expect further benefits of iron cost savings coming in fourth quarter, or we are broadly fourth quarter captures for the savings on natural rubber and synthetic rubber and other commodities?
The RM cost has gone down, and we see that at least for the first half, the RM cost would be subdued. But we are keeping a close monitor on the movement of the RM and commodity prices. But we feel that going forward, it will be in that range bound, and our margin expansion would happen.
Okay. So on at least on sequential basis, margins, gross margins will be more or less stable, and operating leverage will drive a bit of margin expansion. That's the way one should look at it, right?
Actually, the margin expansion has happened on sequential basis also in Q4, as you would have noticed.
Yeah, sorry, I'm referring for first half, FY24.
Yeah, so in FY24 first half, I think further margin expansion definitely can happen, provided the raw material price scenario remains in a stable mode. So that is more likely.
Got it. And lastly, can you talk about the capex which we plan to incur in FY24, both in India and Mexico?
We have already announced our capex plan, which is already underway. In the passenger, we have announced 530 crores, which is expected to start by Q4 FY24, and truck radial expansion in the tune of 260 crores, which we are looking at the FY24 Q2 to start. So totaling of 790 crores expansion is already underway right now. So this is our plan right now.
Right. So but how much of this will be cash flow basis invested in FY24?
So basically, these projects, as just now MD has said, these projects will get completed in this financial year. And because this was staggered, the cash flow was staggered over the last financial year as well as this financial year. And a part of the funds will be spent in next financial year, although the projects would get completed in this financial year. So this will be approximately 500 crore rupees of the total capex outlay would be there in this financial year.
Got it. Great. Thanks. This is very helpful. I'll come back in queue.
Thank you.
Thank you. The next question is from the line of Ashutosh Tiwari from Equirus Securities. Please go ahead.
Yeah, hi. Firstly, on this volume growth side, you mentioned 14% growth in domestic sales in this quarter YOY. So this is a tonnage growth, or this is what exactly? Is it tonnage growth or overall volume of tires only?
Volume, numbers, domestic numbers.
Okay, but see, I think overall the sales has grown by, like say, 9% YOY. Even if the export would have gone half, then also this number appears very high because there's some price increase as well YOY. So can you give the arithmetic how much decline happened in export side?
No, this number of which you are asking, it is actually this 14% is the number growth from Q4 to corresponding Q4 of last year.
Yeah. I'm mentioning same only because the revenue growth is 9%. And how much decline happened in export side? And if you can provide maybe overall volume growth at company level in this quarter, including exports.
So that is broadly a flat, no, in terms of value.
No.
He's asking for in terms of volume.
Volume.
Right?
Yeah, volume YOY at company level, in overall standalone level.
Overall at the company level, this is flat.
So 14% growth, exports is around 16% of our sales, right, at the India level. And if so, I mean, maybe doesn't, like say if your exports has become zero, then probably can say 14% growth in domestic. It doesn't match basically, the numbers are not matching up.
So we will clarify to you. If you can please send us a specific question, because I think there is no doubt about what we have just stated on that.
Okay. And secondly, on the margin side, if you look at other players, generally they reported around 3% minimum increase quarter-on-quarter EBITDA margin level. But we have only reported 1% improvement in margin quarter-on-quarter. So what's the reason why our margin expansion is lesser than the other players in the market?
So, quarter 4 FY23 witnessed a margin recovery by almost 110 basic points over the previous quarter. There was some usage of high raw material inventory during the quarter. And during the quarter as well, there was a change in the market mix where contributions from export sales were lower. So that did impact on the margin.
So how much export sales in this quarter versus like in Q3 was around 16%. This quarter was how much in the mix?
Could you repeat the question, please?
Exports contributed how much to sales in this quarter? It was around 16% in the third quarter.
So the quarter-on-quarter from the consolidated basis,
13% is the sales.
13%.
Export sales in this quarter.
Okay, 13% versus 16 this quarter.
Yeah.
Okay, and this you mentioned that you consumed high cost inventory in this quarter. So how do you look at, like say, what kind of target margin we have, like say, as management, what we are looking at company level over the medium term?
So I think we should get back to the normal long-term average, which is about 12%. So I think we should improve the margin further, subject to, of course, as I said earlier, the stability of the raw material at the level at where we are today. So we can get back to the normal level of about 12%.
Okay, with the RM at current levels, you can get back to that margin.
Yes.
And lastly, can you provide a mix at India operations? We have not provided this time the PPT for the quarter and the year. What it was in the only India operations, the sales mix.
So sales mix for the quarter 4 in the replacement market is roughly around 60%, which is the same as we have seen even last quarter also. And OEM has gone up. OEM has gone up to about 1/3 of the total sales, and the balance is export.
And in the product side, like the trucks, truck and bus, PCR and all?
So truck and bus is again, this is our major revenue contributor, which is at about 60%.
60%.
Including bias and diesel.
PCR and two-wheeler, three-wheeler?
PCR would be approximately 25%, and the balance is non-truck and the two-wheeler.
Okay, got it. Thank you.
Thank you.
Thank you. The next question is from the line of Mitul Shah from Reliance Securities. Please go ahead.
Thank you for the opportunity, sir. First question is on the Mexico operation. His revenue growth seems to be close to 30%, and just now in initial remark we highlighted somewhere around 14% for Tornel. And on the same Mexico operation, the margins are roughly 4.2%, which is almost like a 8-quarter low, despite commodity being much lower and revenue-wise it's growing so fast. So any clarification, sir, here?
Yes, as I had said in my opening remarks, that there has been resistance from particularly the US market, and there have been some stocking of inventory levels with the distributors. And this is mainly because, as you may have heard from some other tire manufacturers also, that the freight rates have come down drastically. And that has put these stockists and dealers and distributors into a bit of a disturbance on a short-term basis. And these are getting cleared. So going forward, we are expecting that now things will normalize.
Have we seen improvement in April and May already, or still more or less situation is slowly improving?
No, we are seeing some turnaround and better sales beginning from April 23. So there is amount of some improvement. Prices are, of course, still in the export market a little under pressure, but I think going forward that will also ease.
Okay. Sir, in replacement, based on the number you just highlighted, it seems to be there is a 23% kind of a growth happening in the quarter. So what is the outlook here, and which segment you think will have a double-digit growth in the replacement side in FY24?
Yeah. So we see that, the automotive industry is very buoyant, particularly in the CV and passenger segment, which is leading the industry. We are seeing that this strengthening in FY24 with back of infrastructure push by the government and the core industry picking up. So we see the commercial vehicles coming in back very strongly. And also with the chip shortage, we also see that the passenger car segment is also coming of place. And even the rising disposable incomes, and we are hoping that good monsoon will come. So we are seeing an overall rural growth also picking up. So we are very optimistic about the growth story in the coming years, backed up with uptick in the economic activities. So here with urban infrastructure and road construction projects picking up.
Remain very optimistic.
Okay, sir. Lastly, again, one verification that CapEx, we indicated that 550 crore for PCR and around 200 crore for additional CapEx. So out of 750, we are going to spend 500 crore in FY24. So next year it would be just 200 or 250 crore kind of a CapEx. Is it right understanding?
No, I think I have said earlier that there is a total capex of 790 crore, 530 crore for the PCR and 260 crore for TBR projects. And this was spread over 2 years period of implementation in FY23 and in FY24. So 500 crore rupees of the outlay on account of capex will be for this financial year. Some part of the total capex is gone in this financial year, and some will go in the next financial year.
So next year it would be much lower, right? Point is it will be like 100, 200 crore kind.
Because the projects will get completed in FY23. FY24.
Okay, sir. Thanks and all the best.
Thank you.
Thank you.
Thank you. The next question is from the line of Amin Pirani from JP Morgan. Please go ahead.
Yes. Hi, sir. Thanks for the opportunity. Just a clarification on the capex thing. So for this year, in terms of cash outflow, you are saying around 500 crores that you will be doing in FY24.
Right.
And does this include any maintenance capex that you normally do?
No, so I have told you for the expansion projects only. So, but in addition to that, there will be some capex on account of the normal maintenance capex.
Okay. Can you give a range? Like, will it be in the range of 100 to 150, or could it be higher than that?
That is normally the case for the year. So that should be broadly the number.
Okay. And given that you said that you're already running at 90% capacity utilization, so can you give us a sense, that at least for PCR and TBR after these expansions, how much capacity, would increase broadly? And what is the scenario for the other categories? Because, if the growth continues, then again, your utilization levels will again remain high. So just trying to get some sense here.
So here with the capacity coming on board, for the PCR, we are looking at 35% increase from our existing capacity. And here, and in the TBR, we are looking at close to around 10 to 12% increase in our capacity in the TBR. So that should be good to cater to the demand as well. And further, we will, when we solidify our position, then we will further talk about the announcement further going.
Okay. So, sir, looking at this, would it be fair to say that the deleveraging, you did around, I think, 400 crores of deleveraging last year. Would it be fair to say that this year the deleveraging could be maybe in line or slightly lower, but a larger deleveraging may happen in FY25? Is there a correct way to look at it?
So as we have said that the deleveraging is going to continue even in FY24 and go down the line. So this will be there, and in fact we are going to pay about 450 crore rupees towards the scheduled repayments during this financial year. And of course the new loans will come in to support the expansion plans which we have taken up. Right? So to that extent the loan amount will go up. But as far as the existing loans are concerned, those will get reduced over the next 2 years by almost about 30%. So it will be very small amount compared to what we are going to pay over the next 2 years. There will be some addition of new loans, and that is for the expansion projects.
And in any case, as the volumes go up, the working capital requirement also goes up. But as Sanjeev has already clarified, that the strict control on the working capital is being maintained, and as a result of that, we have been able to reduce on the both term loans are being paid on the due date and strict control on the working capital, so that the overall there was a reduction of about 400 crore plus in 22-23, and we expect decent numbers for 23-24.
And just to further add to this point, in fact, in the last couple of years, because the input costs have gone up by almost about 30%, and the volumes have also gone up. So the operation levels, which were there about a year ago in FY22, which were there at about 12,000 crore rupees, and in FY23 it was about 15,000 crore rupees. We have been able to control the working capital levels at what it was in the previous year. So there is a very tight control over that, and this is a part of being the deleveraging the strategy which we have adopted. We will continue to be focusing on that, and we will maintain the levels where we are today in terms of the working capital. And that is why I said at the beginning that the net debt to EBITDA and net debt to equity ratios, the leverage ratios have improved significantly during this financial year, and we are seeing that this should improve further going down the line.
Thank you. Thanks for the color, sir. I'll come back in the queue.
Thank you.
Thank you.
Thank you. The next question is from the line of Bharat Bhagnani from Living Root Capital. Please go ahead.
Yeah, hi, good afternoon, team. My question is on the margins, the operating margin that we are at. We finished the year at about 9%. Now, given the raw material scenario in the second half of this financial year, which has just gone by, as investors, we were expecting for better operating margins, compared to even some of your closest competitors within India. Looking at their only India business, they have also got better operating margins. So which brings me to the question that are we trying to chase sales at any cost? Are we not focused on maintaining margins while growing?
This question was also answered some time back, that we had an improvement of around 110 basis points as compared to the previous quarter, and we actually had some high cost raw material that had flowed from the previous quarter, but now that is behind us. That is well consumed. And also another aspect was for us, especially the export sales were down as compared to our quarter 3.
Yes, I heard the question, sir. Just to interrupt you, I heard the question, and I've been there on the call. Now my question is, if we are having some high cost raw materials, are we pre-buying a lot of raw materials at that point? Because how are the other companies able to secure a better margin than I think when they are operating in the same field?
So I think
and there is almost a 20% difference in absolute values.
This is also a function, as Mr. Kothari was explaining, for the product mix and also the market segment. So we are not, for that matter, chasing only the volumes, but of course, we are focusing on the improvement of margins, and that is how in the last quarter, on sequential basis, there has been some increase in margin, and there are reasons for not so much of increase as you might have compared with maybe some other company. But the fact is that we are focusing on the margin side as well.
Right. And there we are focusing also on our product mix in terms of premiumization of our products in different categories, be it in the truck radial, be it in the passenger radial, and others. And as you heard in my speech, that we have also launched ultra high performance tires, Levitas Ultra. So that is also our journey towards that premiumization.
So, Mr. Singhani, then we have been working on improving our product mix ratio for a while now, right? Because of our Mysore facility where we do the R&D, and we have introduced some good products like the JUH5, etc. in the past also. So it was expected that because of introduction of those products, we will be able to sort of capitalize right now when the CV cycle is on an uptrend and 60% of our volumes coming from the CV sales. There was an expectation that we will be able to capitalize more, but that somewhere is not happening. We are not able to charge a premium for our products which we have introduced, which have been well accepted by the market. So is it that we are selling a lot of B2B to transport companies directly for attaining the volumes? That's my primary. That's what I'm trying to understand on the sales mix that's happening.
See, one thing which we need to also understand is that our total revenues that come from the truck and bus side is higher than the others. Right. So there, the segment-wise play out is definitely going to be different, and that is why our MD also emphasized that we are working on increasing the revenues from the segments where the margins are traditionally higher. So we are working on that, and we have made good progress on that. In fact, if I were to just give you one number, is that in our passenger car, while the overall growth we talked about 14%, but in passenger car, if you look at passenger car separately, the growth was almost at a level of 17 to 18%. So that indicates that we are trying to kind of increase the overall revenue mix. And as overall category also, the revenue mix in passenger car has gone up by a couple of percentages. So this effort will continue, and thereby I think so we will be able to get a richer product mix, which will help the margins to get better.
So this is a concern for you also, that you want to get the margins better going ahead.
Yeah.
Right. One more question for Sanjeev ji. Sanjeev ji, tax rate on an overall basis continues to be around 35-36%. Are we not migrating to the new tax offered by the government of 25-26%? We are not able to do that?
No, so there actually, because last time also I clarified, there is some outstanding credit to our account on account of MAT, minimum alternate tax. So once that is absorbed, then of course we will move into the new regime.
So that should be absorbed by what?
This we have evaluated, which one is better for us, and we are waiting for that to be absorbed first, or let's say utilized first, and then we will move to the new category.
Is there a sort of timeline or you can share that?
I think it's a matter of only about a year or so.
1 year.
Yeah.
Okay. That's all from my side. Thank you.
Thank you.
Thank you.
Thank you. The next question is from the line of Deepak Jain from Enam AMC. Please go ahead.
Hello, sir. Sir, again, I have a question on the margin. You said that you are focusing on premiumization, and earlier there was a comment that probably the product mix may have deteriorated. So can you just clarify that aspect?
So first of all, we would like to clarify that there has been no deterioration. In fact, there has been a sequential improvement, and what we said is that we would further try to make it superior in terms of the product mix, and that is where our efforts on the passenger car radial premiumization, going for the higher rim sizes, including the launch of Levitas Ultra, which is in the premium segment for luxury cars, and not only Levitas, but also generally looking at the 16-inch and above sizes in the passenger car, both with the OEMs as well as in the replacement market. So that is our effort towards getting the product mix even better. So there's no deterioration, just to clarify.
Sir, you talked about margin, getting improved to 11-12%. From which quarter can we expect that?
It's a continuous process. So we said that for the entire financial year, we are expecting this to improve. The way we are seeing actually the margins in the fourth quarter, it should further improve, and the reasons were stated earlier also. The high cost raw material inventory was there earlier, which is now behind us. We have consumed that. And if the raw material scenario continues to remain in a stable range, then of course we will see the benefits starting from Q1 onwards.
Sir, one last question. Given the moderation in the cost, do we see some price reduction, particularly in the OEM category, which you may have to pass on?
See, this is something which we'll have to see how it plays out. The only thing which I can comment right now is that wherever there is an indexation, that definitely will have to be responded accordingly. But other than that, we'll have to see how it plays out, because we also need to keep in mind that when the raw material costs were going up, the complete recovery had not happened.
Okay. Okay, sir. Thank you.
Thank you.
Thank you. The next question is from the line of Shubham Agarwal from Equitas Investment Consultancy Private Limited. Please go ahead.
Good afternoon, everyone, and thank you for the opportunity. So my questions are around the P&L. So if we see the employee expenses, since June, it has been increasing drastically, and almost at a similar level of gross sales, we have seen decent increase in employee expenses. So I wanted to understand if there is any specific reason why this has happened, and how do we see this going forward?
See, overall, this year was the year where we had some long-term agreements in a few of our plants. So that is valid for more than once an agreement happens, it goes on for 3 to 4 years. So definitely it will get averaged out over the next 3 years time. And overall, yes, the top line will also get robust in FY24 with the growth that we are seeing. So this should help us do that. Plus, we are also working on a lot of digitalization measures, which should also help us in this regard.
Okay. So we can consider a low single-digit kind of growth for FY24 in employee cost. Correct?
Yes.
Okay. And then coming to the interest expenses, given that we are almost at the fag end of the rising interest rate scenario, and also our overall debt level is going down, do we expect this to, peak out at 125 crores?
Can you repeat your question? Sorry, we couldn't hear you properly.
Can you hear me now?
Yes.
Yeah. So my question was on the interest expense. Given that we are almost at the fag end of rising interest rate and also our overall debt levels are going down, do we expect this 125 crore to kind of has peaked out for us in terms of interest expense?
That is on quarterly basis you're talking about.
Yes.
So I think
yes.
this is, to my mind, this is peaked out, you are right. And going forward, as we expect that after some time, there is a chance of even reduction, probably. So if that happens, then definitely we will be able to get the interest cost reduced.
Got it. And on the Cavendish side, so we hold almost 80% of the company. Do we have any plans of acquiring it 100%? And if so, by when? Hello?
Holding 100%.
So I think we are likely to remain at the same level for the time being. This is also because 100% of the company is owned in the group only, and 80% roughly is held by JK Tyre.
Okay, so no plans of increasing. Got it. And lastly, I wanted to understand what will be our strategy beyond FY24. Because in terms of expansion, I think the volume growth is only around 10 to 15%. So how do we have any scope of brownfield expansion beyond FY24, and how are we planning to grow?
So yeah, we are, as I said, that our capacities will come in place of the truck and passenger around this quarter 4 of FY24, and then we will start utilizing that capacity, and then we'll assess based on the demand in terms of whichever plant has got the scope of a brownfielding, we will come back when we decide on the capex cycle.
So just a clarification on this. So earlier in the call, you mentioned that PCR would increase by 35%, right, after this expansion. But my earlier understanding was that this 35% increase also includes the debottlenecking which was done last year.
That's correct.
So
That's correct.
You are right. So in fact, I wanted to clarify that 35% includes partly, which is almost about 50% has already been completed through debottlenecking, and 50% of that, which is about 17%, that is under implementation at the moment.
Got it. So 10 to 12% in TBR and almost 17% in PCR is what we are expecting.
That's correct.
That's absolutely.
Okay. And in one of the news article, it was mentioned that in FY25, JK Tyre may see a 900 crore expansion in PCR. So is there any validity to this news?
No, so this 900, I think there was earlier, I will clarify the point, 1100 crore rupees of total expansion we had talked about at some point in time in FY22. And then because the debottlenecking project of rupees 305 to 310 crore got completed already, and the balance 790 crore is undergoing. So this totaled up to 1100 crore. So, but I don't know this 900 crore rupees figure, so maybe wrongly published something.
Got it. No, thank you. That is very helpful. Thank you for answering my question.
Thank you. The next question is from the line of Amit Agrawal from Leeway Investments. Please go ahead.
Good morning, sir. Congratulations for good set of numbers. My question is regarding the money you raised through IFC. Sir, for a company like ours, raising 240 crores at such a low valuation, what is the thought process of the management regarding the same?
Please, could you repeat? Didn't get the question quite right.
For a company size like ours, raising 240 crores at such a low valuation, the valuation will be considered at 180 rupees after 18 months. So don't you think it's a very low valuation for the issue? What is the thought process of the management? It's a 240 crore is not a very big amount.
So this is based on the negotiation one, and then this fair value arrived at through a valuation report. So this is all these details, and I think the negotiation happened at the time when the share price was hovering at around the same level. So I do not know what is your way of calculation of low or high. So that is difficult to comment.
Because compared to peers, our valuation otherwise is also very low. I don't think with this brand like ours, we should remain at this level for too long.
I don't think there will be any possible comment on this, that the negotiated price, the deal price, which has already happened. So this was at what valuation, what should have been done. So it's very difficult to comment at this point in time.
And do we expect any further dilution of the equity in near future?
So again, we keep exploring the possibilities, but as of now, we can't comment.
Okay, thank you.
Thank you.
Thank you. The next question is from the line of Neerav Seksa from Living Root Capital. Please go ahead.
Yeah, sir. What is the holding period of raw material? Hello?
So for imports, normally it takes like from the date of order, it takes about 2 months to consume the material. And in the case of local, it is about 25 days to 3 weeks, basically. 3 weeks of the holding.
And just to repeat on the margin side, we expect the margin to peak at 5%, around 11 to 12%, if I'm not wrong.
Your voice is not very clear. If you can, it's breaking.
So is it enough?
You can try it out again, please.
Yeah, I'm saying, if I'm not wrong, the margin should peak at around 11 to.
So we have clarified this already. So considering the stable raw material prices, I think we should improve upon the margins. But at what level it will peak is again difficult to say, because we have the precedence of increasing the margins to a level of even 15 to 17% if you can refer back to even FY21. So this is all because of the raw material price scenario, we can improve upon. But we have seen already a high raw material price scenario, so I think it has bottomed out probably.
Okay. And could you also mention the input prices that?
Not clear. Sorry, your voice is breaking too much.
Yeah, I'm saying, sir, could you mention the input prices that you saw in the Q4 for synthetic rubber? Okay.
So you are asking for breaking up of the prices, you are saying? If I
Yes, sir.
So not readily available, but yes, we can discuss maybe in the next conference call.
So Q4 data isn't available?
No, Q4 data is not readily available with me. Breakup.
Okay, sure. Thank you, sir.
Thank you. The next question is from the line of Raghvendra Goyal from ICICI Securities. Please go ahead. Mr. Raghavendra Goyal, your line has been unmuted. Please go ahead with your question.
Hello. Am I audible now?
Could you please move a little closer to the microphone or use your handset while asking the question, as you were very low audible?
Sure. Can you, sir, please provide me revenue numbers for the Cavendish for the current quarter and corresponding margins?
So for Cavendish for Q4, the turnover was about 670 crore rupees, and the EBITDA margins were at about 11%.
And what would be a utilization level at Cavendish for the Q4?
85%.
85%. Okay.
Thank you. The next question is from the line of Naitik Mohata from Sequent Investments. Please go ahead.
Thank you for the opportunity. Sir, if you could just clear the picture around debt or rather our deleveraging plans. Because yesterday, Anup sir in a CNBC interview said that we plan to bring the debt down from 4,500 crore levels to 3,500 crore levels. And now you're saying that we pay off some old debt but take on new ones, seeing our capex plan. So what is the deleveraging policy and how the picture can be painted for 24? And secondly, will this debt reduction will be facilitated all from our cash flows, or do we plan to raise some kind of funds going forward?
No, so for today, as I said earlier, the total net debt is at company level, at consolidated level, is 4,500 crore rupees. And we have the scheduled repayments in the next two financial years of almost about 900 crore rupees, 850 to 900 crore. So the total long-term debt will go down by about 30%. Okay, so and assuming that we will be able to maintain the working capital at the same level, and even if there is some addition of new loans for the expansion project, there will be a complete reduction of the long-term or the net debt from 4,500 level to 3,500 level. So that is what Mr. Kathuria said. And that
okay, sir.
Yeah.
And secondly, this will all be from our cash flows, or do we plan to raise some funds?
No, this will be from the internal accruals and our own cash flow.
Okay. Thank you, sir.
Thank you.
Thank you. The next question is from the line of Mitul Shah from Reliance Securities. Please go ahead.
Sir, thank you for follow-up opportunity. Sir, again, question on Mexico side, as we are hinting on the tough situation in America. So do we expect double-digit growth in volumes or value terms? So what is the outlook here for next 1 to 2 years?
Yeah, well, the outlook is definitely better. As I said, that we are expecting that the US market is definitely going to revive. And therefore, we are targeting double-digit growth for financial year 24.
What is the industry situation, sir? As you highlighted, there is already like a destocking and overstocking in the system. Inventory is high. So what are those challenges?
So as I said, that process has certainly affected performance to an extent. So whatever we have said would have been still better. But the performance of J.K. Tornel in the last 2 years has been very, very good. And hopefully now this process of destocking should be over somewhere in the middle of Q1 of financial year 24.
Okay, sir. Thanks.
Thank you. As there are no further questions, I would now like like to hand the conference over to Mr. Singhania from JK Tyre for closing comments.
Thank you very much for being with us today for the call for FY23 for the quarter and FY23, and hope we've answered your question to whatever your satisfaction. And on behalf of JK Tyre, I'd like to again thank you.
On behalf of ICICI Securities, that concludes this conference. Thank you for joining us, and you may now disconnect your line.